Okay, so now continuing from the previous lesson, let us proceed further, a step ahead, alright? Now we have seen that the company was into manufacture of garments and they came out with an IPO to garner additional funds. They want to now export the garments also, and the company is now flourishing in the export of garments, alright? So in the next 5 years after the IPO, the equity of the company remains the same. 10 million from the promoters, 8 million what they had collected from the public. That equity remains the same, 1.8 million shares of face value $10 each. 1 million shares held by the promoters, 0.8 million shares held by the public. But in the next 5 years, the reserves and surplus keep on increasing. Why? Because every year the company would earn profit. Some profit they'll take as dividend, and the balance of profit they will reinvest for growth of the company. So the company keeps growing, and the reserves and surplus over a period of 5 years, let us say it comes to 150 million. Alright? And the debt becomes zero because over the next 5 years after the IPO, the company would gradually repay that debt. Now it has got adequate money, so it does not want to keep debt from the bank. Over a period of 5 years, they repay the entire debt. Alright? And now the company wants to diversify into manufacturing and export of sports equipment. So far, it has been exporting garments. Now they want to diversify. They want to manufacture and export sports equipment also. And for that purpose, they require additional $100 million. Alright? 150 they already have in that kitty. 150 plus this 18 million they already have. They require 100 million more to diversify. Okay? So what they will do? They again want to offer additional shares to the public. 0.8 million shares they have already offered. They want to offer additional shares to the public. So they will come out with a public offer again. But what will that public offer be called now? It will be called as the follow-on public offer or the FPO. Same thing, but you cannot call it as initial public offer because initial is the first time. That first time is over. Company has already taken first time for entering into exports of garment. Now this is the second time when they are asking for the public money. So therefore it is called as the follow-on public offer. Maybe they'll come up again for the third time. Again it will be called as a follow-on offer. Maybe the second follow-on offer. Alright. And how will this follow-on offer be priced? In a similar manner as what has been done during the IPO. The face value will still remain $10 per share, but the premium may increase depending upon various factors. How much the company has grown, what are the future plans of the company, and the same factors what we had discussed during IPO. Considering all those things, the premium may be much more, but the process in principle remains the same. Alright. So now when an IPO or an FPO comes, there is a lot of enthusiasm in the public. Okay, though the IPO or the FPO are offered at huge premiums, but still there is lot of demand. People want to subscribe for these IPOs, thinking of getting some money at listing, making some gains at listing. Alright. If a company is operational, if the company is already running, and then it is coming up with an IPO, it would mean that so far before the IPO, all the shares were held by the promoters. Alright, there were no public shareholding, only the promoters were holding the share, and therefore now for the first time they are offering shares to the public. IPO. Alright, we shall discuss only the IPO because IPO and FPO the process remains the same. Alright. And during the IPO, they are wanting more money by offering additional shares to the public. Why this I have written in capital additional, we'll discuss a moment later. Alright. So the first thing that you must see while subscribing to an IPO is whether the premium which the company is asking is justified or not. Alright. So the shares will always be offered at a face value plus premium. And the face value plus premium together is called as the offer price. So whether that offer price is justified or not. Face value of course is justified because it is the same for the promoters as well as the public. But is the premium justified? What will the premium depend on? We have already discussed that premium will depend on these things. The difference in the book value, how much is the confidence in the business level, how many loyal clientele are there, how much is the market share of that company, what is the scope of profits in future, has the company established itself as a brand name, is it known to the public, various other things. But the fact is that it is very, very difficult for common people to evaluate these aspects and decide whether the premium is justified or not. Normally what people do is they go by the recommendation of the experts on the TV channels. But the question is, are these recommendations always non-biased? There is a question mark in my mind. So what I would recommend is, as common people, what we can do is, we can look at three major aspects of an IPO and then make a judgment whether the premium is justified, whether it is worth investing in the IPO or not. And these broad three major aspects are, first of all, we need to know as to what the company wants to do. And then what about the promoter holding and the debt status? Let us discuss individually each of these aspects, which is very easy for the common man to find out. Alright. So the first thing, what does the company want to do? Does the company want to expand the current business? If the company wants to expand the current business, then that would mean that the demand for the current product already exists, and then only the company is wanting to expand. So it is a good sign. You can think of investing in this company. Alright, only if there is a demand for the current business, the company would want to invest more. But if the company is wanting to start something new, then there is a question mark. You will have to see how much is the risk involved in the new business. For example, say, let us talk about the same company, Five Trend Garments Limited. Now they were making the garment. The first time they wanted to increase the capacity for making garments to export the garments. So as far as I can think, the confidence level was high. The same business they were doing, they wanted to expand the same business. What they were supplying locally, now they wanted to export. So it sounds good. But when they were coming up with an FPO, they wanted to diversify. Their niche area is manufacturing garments. But from that, they want to diversify into sports equipment. Are they experienced in making sports equipment? How much is the confidence level? What is the risk involved? So I would see it with some suspicion. Alright? I hope you understand the general decision making logic. Then the promoter holding. Now you see, in our case, initially the promoters were holding 1 million shares at $10 each, that is 10 million, and the public was holding 0.8 million shares. That means the contribution or the share of the promoter was more. So therefore, it builds in confidence that the promoters are holding a major stake. So therefore, they would not do anything which will harm the company. Alright, so they'll take care of the company. So if the promoter share is further increasing in the IPO or the FPO, if the promoters themselves are further contributing, then it is a good sign. It increases the confidence level that the promoters themselves are putting more money. So why shouldn't I? Alright. But if the company or the promoter's share remain the same, if the promoters are not putting anything extra, they are not putting anything more with the public, then okay, it is not bad, neutral, alright? But if the promoters are offloading their shares through the offer for sale, sometimes you may find that the IPO or the FPO has got a component called as offer for share. Like in our case, the promoters were holding 1 million shares. Sometimes the promoter may offer to offload or sell off their own shares. Out of 1 million, they may be wanting to sell off, say, 0.2 million shares during this IPO to the public. But that is not a good sign. If the business is doing more, if the promoters are very confident about the business, if the promoters feel that the business is going to grow further, then why would the promoters sell their stake in the business if the business is doing good? So therefore, when you find in an IPO document that there is some offer for sale, the promoters themselves are selling off a portion of their holding, then you must look at it with suspicion. Why is it that the promoters themselves are selling and they want the public to buy? A question mark. Alright. And then the debt status. You see, the company has some debt. In our case, it was a very small amount, just $2 million. It could be more also. Sometimes the debt could be 50-50 also. Debt equity ratio could be 1:1 also. Now you have to see whether the company is using the IPO money to repay the debts. That will be mentioned in the document. If they want to do that, they have to disclose it. But then the question should come into your mind as to why the company is borrowing money from the public, or not borrowing. Why is the company asking a stake from the public and then repaying the debt? Because if you recollect or lesson in one of the other courses about the debt equity ratio and the financial leverage, if the debt is working good for the company, if the company is earning a profit more than the amount of interest which it has to pay. For example, if the company is paying an interest on debt at the rate of 10% and the company is earning profit at the rate of 15%, then why would the company want to repay the debt? Alright, the company would want to repay the debt only if its profit are turning out to be less than the amount of interest which it has to pay, and the company is not able to tolerate paying that interest. For example, if the debt is at 10% interest and the company is making only 8% profit, that means from the shareholders' money, the company is paying the additional 2% interest. Alright. So therefore, if the company is taking money from the public to repay the debt, it should be looked at with suspicion. It is a tricky question, a question mark. You have to be very careful while investing in such a company which is asking money from the public to repay the debt. And lastly, sometime you may find that the company is incurring losses. After its inception, for a few years, the company keeps on incurring losses. And still it comes out with an IPO at a premium. They are themselves incurring losses and they are selling now, offloading or probably asking people to contribute for the shares at a premium. Is that justified? Often you would have seen in the market that IPOs come at a premium, but the company is loss making. Now you need to understand this. You see, when a company starts, most of the time when good companies start their business, they invest a huge amount. Alright? Let us say this is vertical y-axis is about the money and the x-axis is about the time. Alright? So a company invests a huge amount, and for a few years, the company will keep on pumping money and sustaining losses. Because they are making a customer base. Initially, the company may sell their products at a loss to make a huge customer base. They will invest a lot of money in marketing, advertisement, making the infrastructure. So the company keeps on going into a loss. They keep on incurring a loss till a particular time. Okay. And at this particular juncture, the company is now ripe. And from next year onwards, they are in a position to make profits exponentially. All right. They have taken this couple of years, maybe 2, 3, 4, 5 years, to make their base, establish a customer relationship, incur a lot of losses, but now they will come up with a bang and make huge profits. So therefore, you have to see that whether it is a good business which in the normal circumstances have incurred losses for making their foundation strong, for making a good customer base, or is it by default a loss making company? Alright, you have to see that. And then before investing, see, you have to see where you are investing. You are investing at this juncture, at this juncture, at this juncture, at this juncture. Accordingly, the premium will be different. If you probably want to invest at this juncture, the premium will be still more because now the company is profit making. Alright? But whatever the case may be, before you invest in a company which is a loss making company, you have to see the three aspects which we have discussed in the previous screen. Alright? All those three aspects. And more important, or the most important, is the promoter stake. Are the promoters increasing their stake, keeping their stake unchanged, or reducing their stake? If the promoters are reducing their stake, then please remain away from such a company. Why would you and me want to invest in a company where the promoters themselves are wanting to get out? Alright. So I hope this concept of IPO, FPO, and broadly their pricing is very clear to you. Actually, we should have discussed this topic towards the end, but in the flow when we were discussing it, I found it very appropriate to discuss this topic here, and therefore we have taken this lecture at this juncture. Alright.